In this video, traders, we're going to look at what do traders look for in PE ratios to make the best decision. Stay tuned. Hey guys, warm welcome to you. Okay, so PE ratios are really the foundation for many fundamental investors' decisions. They look at the PE ratios and then make a decision. So what do traders actually look for in a PE ratio? First of all, what is it? And what patterns do they look at to see if it's undervalued or overvalued, whether they should invest in the stock or perhaps whether they should consider selling the stock? All right, so PE ratio is price to earnings ratio. You're basically taking the stock price and you're dividing it by the earnings per share and you're getting a number. So for example, if you have a $20 stock and the earnings per share is $1, and this is reported by the company on a regular basis, normally quarterly, your PE ratio will be 20. Okay, if they start earning $2 per share, all of a sudden your PE ratio is 10. So in other words, if the earning power has increased and they become more profitable, but the stock price hasn't gone up, then the PE ratio is lower. And on the flip side, let's say for example, the stock shoots up to 200, but it's still only earning $1 per share, all of a sudden that PE ratio will be 200. So you can see a higher PE ratio generally, and this is very, very broad, we'll dig down this in a second, is overvalued, lower PE ratio, undervalued. That's putting things in very simple terms, but broadly speaking, that's kind of what it's all about. So we have PE ratios. Different sectors will have different PE ratios. In other words, you have maybe a tech sector that's got a high price to earnings ratio because there's potential for future massive growth. You might have a slower kind of steady sector that's got a really low PE ratio, and that's the norm. It's about comparing current PE ratio to a baseline. So we're looking at consistency of earnings, and sometimes you'll have tech stocks that are wildly different earnings and that might create different evaluations in PE ratio. But if you've got consistent growth, consistent solid earnings, consistent stock price growth, then the PE ratio may well stay the same, or it may well slightly increase based on what people are expecting in the future. So anticipation for future earnings as well. How is the company growing? What is the anticipation for the next year, for the next 8 quarters, whatever it may be? That's going to have an impact on the PE ratio. If the anticipation is, hey, do you know what, this is just a boom, they've kind of had a short-term win, we don't see them having any market share or being profitable, then that PE ratio could go down into single digits, because even though the earnings per share happens to be quite high, people know and expect that actually the earnings per share in the next quarter or the quarter after that are going to be very, very low, and they're basing it on that. So future earnings per share is something they'll be looking at. And then how do we know if it's high or low? Is the PE ratio high or is it low? So the two things to look at is comparing it to historic PE ratios for the company. So if the company has had a PE ratio that's sat and it's been sitting at 20 and all of a sudden we're now trading at 30, you could consider that as high. But then you'd also got to compare it to others in the sector. Like I say, different sectors have different general PE ratios. And you want to say, okay, well, this PE ratio in the retail sector, how does it compare to other peers that are similar, other people, other companies that are selling the same kind of thing in the same kind of country? Oh, it seems to be significantly high. Why is that? And then you look at that and say, well, is there a reason for it? What is it historically? Historically, it's been very, very normal, or it's kind of increased, or it's been in this kind of range. So, where does that sit in the median of the historic PE ratio? What about the sector? Then you can compare the two. Then you can go, okay, well, actually, PE ratio is low. But then you've got to have a third thing that you look at, and you've got to say, well, if the PE ratio is low and it's been declining, i.e. the earnings per share has perhaps been declining, the stock price has been sitting there, maybe the stock price has been declining further than the earnings per share, because obviously if the earnings per share is declining, the stock price stays the same, it's going to affect the PE ratio. The PE ratio is going to go higher. But if we have the earnings per share perhaps declining, the stock price declining more, the PE ratio would go lower, but that doesn't necessarily mean it's a good value purchase, because ultimately if the earnings are dying, then unless there's a catalyst that turn those earnings around, then it doesn't matter what the PE ratio. The PE ratio is only a mathematical formula. The real juicy part is this earnings. So if there is a catalyst that's going to turn the earnings around, perhaps the stock price has gone so low, now the earnings per share is starting to bottom out and starting to see it lift up, you might see then a really low PE ratio and a good potential for a lift up, because earnings might start to increase, stock price will catch up with it, and eventually a PE ratio will catch up to where potentially it was a long time ago historically, and others in the sector. So PE ratio, guys, that's what traders are looking for. They're looking for consistency of earnings, the anticipation for future earnings, and the metric of whether it's high or low is going to be how does it compare to historic and to others in the sector. Those are the two most important things. Take care, whatever you're investing in. Bye-bye.